Welcome to BD Daily Finance News Podcast, your daily briefing on finance and investing. It is 2026, May 29th, and markets are serving a buffet of contradictions. Record stocks, sticky inflation, AI euphoria, a stronger dollar, and oil headlines that refuse to sit quietly in the corner.
So basically, the market walked into brunch and ordered optimism, anxiety, and a side of Nvidia chips. Very balanced diet. For normal investors, today is about separating real opportunity from shiny object cardio.
Story 1. Federal Reserve Bank of Kansas City President Jeff Schmid said officials must keep signaling they are committed to bringing elevated inflation back under control. Simple version? The Fed does not want markets assuming rate cuts are guaranteed just because stock charts look happy.
Central bankers have the emotional range of a smoke detector, but this one matters. If inflation stays hot, borrowing costs stay higher, mortgages stay painful, credit cards keep biting, and your cash flow plan needs more respect than your abandoned gym membership.
Market Pulse also flagged core PCE inflation around 3.3% year over year in its markets wrap, reinforcing expectations for restrictive policy. Think of inflation like a thermostat stuck above the target temperature. The Fed keeps the air conditioner running, and risky assets may love the cool breeze until the electricity bill arrives.
I slightly disagree with the doom tone. Higher rates are not only a villain. Savers finally earn real interest on cash and short-term bonds, which is nice after years of savings accounts paying in emotional support coupons.
Fair reversal. Story 2. CNBC reports Nvidia is investing billions in photonics, a technology that moves data with light instead of electricity and could make AI infrastructure more efficient. Meanwhile, Dell reportedly rallied about 40% on strong Nvidia-powered AI server demand.
Photonics sounds like Wall Street discovered a lightsaber and immediately made a spreadsheet. But the finance behind it is simple. AI needs massive data movement. Data centers need power, and anything that cuts energy bottlenecks can become a margin story, not just a science fair trophy.
For investors, the key question is where revenue is already visible. Dell's rally suggests AI demand is moving into servers, supply chains, and enterprise spending. But when a stock jumps roughly 40%, discipline matters. Growth can be real and still be expensive.
Exactly. Buying after a huge jump without a plan is like showing up to a wedding after the cake is gone and asking if you can invest in frosting futures. Watch order backlog, margins, free cash flow, and whether customers are buying because they need capacity or because everyone is scared of missing the AI bus.
Story 3. Bloomberg says the dollar's monthly rise has strategists wary of more gains as traders price in higher U.S. rates. A stronger dollar can lower import costs for Americans, but it can pressure emerging markets, commodities, multinational earnings, and anyone holding debt in dollars.
Currency markets are basically the group chat where every country is subtweeting the Fed. Japan reportedly used a record $73.6 billion equivalent over the past month to support the yen after it slid past 160 per dollar. And India and Indonesia also intervened to support their currencies.
Why should a middle-class investor care? Because currencies feed into travel costs, imported goods, commodity prices, and international fund returns. If you own global ETFs, dollar strength can translate foreign profits back into fewer dollars, even when the local stock market performs well.
So your vacation budget and your retirement account may both be quietly attending the same foreign exchange seminar. My practical takeaway? Do not overconcentrate in one country, one currency, or one theme, even if that theme currently has excellent marketing and a robot voice.
Story 4. U.S. stocks held near record highs as traders watched U.S. Iran developments and possible progress that could restore oil flows through the Strait of Hormuz. When oil risk eases, inflation expectations can cool. When oil risk returns, transportation, airlines, and consumer prices feel it quickly.
Markets love peace headlines because oil is the economy's drama queen fuel. But I would not build an investment plan on one diplomatic headline. That is not strategy. That is refreshing a news app and calling it asset allocation.
Here is the recap. The Fed is still inflation-focused. AI infrastructure is creating real winners, but stretched expectations. The dollar rally is a global pressure point, and oil headlines can change the inflation story fast. The action step is simple. Review cash needs, debt costs, sector concentration, and international exposure before chasing momentum.
And if your portfolio is 90% AI, 10% vibes, please at least rename it from diversified to enthusiastic. Subscribe to BD Daily Finance News Podcast, share this with someone who says inflation is over every Tuesday, and tell us in the comments, are record highs making you confident or suspicious?